Good morning to you both. David, this chair of the Fed and the other folks on the policymaking front have a lot of message discipline right now, right? They're not going to give the markets an explicit wink to say we feel like the mission is almost accomplished, but place that in the context of what the markets are reading and what they're trying to project ahead to, just how much more is to be done in terms of the Fed tightening.
You know, I think the market's kind of telling you that they have a lot of this priced in, and you said it just before we opened the segment. The S&P's back green today. We got a 75 base point hike from the ECB. We had a leak that looks like a 75 is more likely than a 50 from the Fed, and Jay really sticking with the script, and all of the other presidents and governors sticking with the script. There's no deviation. There's no kind of lone dove out there that's trying to pivot back. It's really a pretty straightforward message. I don't think that message has been deviated upon in a long time. The market tried to pivot it, but I don't think anybody at the Fed did. And I think these levels we're getting to, they're interesting. We might have a little bit more downside. We might have to go test that 3650 again, but I really don't see the case for the big swoosh down to 3,000, 3,100 that a lot of strategists are out there calling.
Yeah, that does seem to be where a lot of the downside targets are kind of coalescing. Mona, just from an overall market kind of risk-reward perspective right here, we did get that very strong rally from June into mid-August. At least part of that was perhaps on this idea that the Fed would shift to a more dovish stance, but not all of it. You had some economic resilience evident as well along that time. Where do you think that leaves us here with again, the S&P about halfway between the June lows and the August highs?
Yeah, look, the Fed probably wasn't thrilled when they saw that rally from June to mid-August. Equities were up, bond yields were down, financial conditions were easing, not really conducive to their inflation-fighting mandate. So I think when Jerome Powell came out a couple of weeks ago at Jackson Hole, he really did reset market expectations here. We saw then equities sell off. We saw bond yields creep higher. Financial conditions are tightening. The dollar is at a new high with the DXY index. And so this is the direction of travel I think the Fed is more comfortable with. We do think going forward, over the next few months, that old adage, don't fight the Fed, certainly still in play. We think there's volatility still ahead. But to the point earlier, we don't think that we'll get another bear market rally if we do test those lows. We do think that a lot of the work to the downside has been put in the first half. Could we see some volatility in September and October, very notoriously volatile months? Yes, but I think over time what we do expect is that inflation will continue to moderate. The Fed will pause at some point, probably by year end. And then we're set up more nicely for a more sustainable rebound. So near-term volatility for certain, probably not testing those 3,100 levels, but could we get back to 3,800 or below? Perhaps. But that sets us up well for a potential period of stability as we head into year end.